Welcome to Finbri, a specialist UK bridging loan broker who can help you arrange your short-term finance fast. Many people, just like you, have questions about bridging loans. In fact, over 100,000 people in the UK search for answers about bridging loans on Google every month. So you're not alone if you've got questions, and I'm here to answer some of the most frequently asked ones for you today. Hi, I'm Lizzie, and I'll be walking you through this guide to bridging loans, a versatile solution for short-term finance. I'll explain what it is, how it works, the process, and how it can be of use to you for both residential and commercial investment purposes. Let's start with the basics. What is a bridging loan? A bridging loan is a type of short-term finance that's typically borrowed in order to bridge a gap in someone's financing, hence its name. It's usually used to finance a property transaction, but it can be used for almost any purpose. And, whilst it can be secured against different types of assets, a bridging loan is typically secured against one or more properties. How much can I borrow with a bridging loan? How much you can borrow using a bridging loan varies case by case, but there are a few basic concepts worth knowing. Bridging loans typically range in size from £25,000 up to £10 million, but there's no actual upper limit. Some bridging loans have been in excess of £1 billion, but these are few and far between. Your bridging loan amount will largely depend on how much you want to borrow, the available equity in your property, the maximum loan to value or LTV for that property type, and what your lender is willing to lend you in specific circumstances. If you're looking to borrow as much as possible, then, as a broker, our job is to maximise your borrowing potential and source the right lender for you so your rates are as low as possible. How long can a bridging loan be borrowed for? A bridging loan is intended as a short-term financial product that helps you get from A to B. It's typically taken out for between 1 to 24 months. However, in reality, the majority of bridging loan terms are 12 months or less. How long does it take to arrange a bridging loan? One of the real advantages of bridging loans is that, in many cases, they're incredibly quick to arrange. They're possibly the quickest form of short-term finance for large sums that you can access in the UK. From initial inquiry to drawing funds, the average timeframe for a bridging loan to complete is 2 to 4 weeks. In urgent scenarios, however, we can complete bridging loans in a matter of hours. For example, for bridging loans up to £300,000, we're able to complete these in just 72 hours. And for up to £700,000, we can complete these in just 5 working days. How are we able to turn around loans so quickly? We're strong at all key aspects of securing your short-term finance. But there's 3 critical factors that really matter in urgent cases. Firstly, we know which lenders want which loans. For fast bridging loans specifically, we have several lenders whose focus is purely time-sensitive lending. Secondly, we're good at packaging loans, so the lender doesn't have to do much groundwork to understand the value in lending to you. Thirdly, our tried and tested process cuts out the red tape and delays from surveyors and from solicitors. For example, according to the latest 2023 survey from Ernst & Young, 81% of bridging loan providers said protracted legal work was the biggest cause for bridging loan delays. So, in urgent finance, we can use joint legal representation that almost entirely mitigates that issue. The same EY survey also showed that 37% of bridging loan providers cited valuer response times as the 3rd biggest cause for bridging loan delays. To overcome that, we can replace in-person valuations with automated valuations, which shaves off an incredible 2 weeks or more from the process. At a time where other bridging loan providers are reporting an increase of 117% in the time it takes them to complete loans, you can rest assured that we're using technology and tried and tested lending partners to get deals done at lightning fast speeds. Will I be eligible for a bridging loan? If you're unsure whether you'd be eligible for a bridging loan, the good news is that the eligibility criteria is really straightforward. Here's the summary. Bridging loans are available to UK residents and non-residents. They're available to individuals and companies such as special purpose vehicles. There are just 3 key conditions that need to be met. Firstly, you'll need to own a property because the majority of bridging loans are secured against property. Whilst a property could be located outside of the UK, there are more lenders willing to lend on UK property than overseas. Secondly, that property will need to have enough available equity in it to achieve an LTV ratio that fits within the bridging loan lender's LTV limits. Typically, the highest LTV is 80%. So if you own a property that's worth £250,000 and it has no other borrowings on it, then the maximum loan amount would be £200,000. Another way to look at it is for every £100,000 of equity you have in your property, the maximum you could borrow would be £80,000. Lastly, the borrower must have a realistic exit strategy. An exit strategy is how you intend to repay the loan at the end of its term. Unlike mortgages, with a bridge loan, there are typically no monthly repayments. Instead, the full repayment is usually made at the end of the loan term in one lump sum. As such, the lender will expect the borrower to have a reliable method of repaying the debt when the loan ends to avoid default. Will non-status or bad credit stop you from getting a bridging loan? The good news is that your credit history isn't necessarily going to stop you from obtaining a bridging loan. This includes bad or adverse credit and non-status. Non-status credit simply means that you don't have much in the way of a credit history. Whilst non-status lending isn't an issue for bridging lenders, if you have a lighter credit history, some lenders may perceive you as having a higher risk of default, which can reflect in slightly higher interest rates being offered. Bankruptcy, CCJs, or adverse credit are also not necessarily a big problem for bridging lenders, but again, be prepared to pay a higher rate of interest, as lenders may perceive you as having a higher risk of default. If you've bad credit, adverse credit, or even no credit history, then my advice is simply to be open about your circumstances. We can often find a way to position your case with lenders where the merits of your application shine through and help you get the best rates. What can a bridging loan be used for? Bridging loans are a super versatile, short-term financial product that can be used for almost any purpose. Here are just a few of the common uses in the UK and Europe. Property purchases and refurbishments. A bridge loan can be used to finance the purchase and refurbishment of a residential, business or commercial property. Fixing property chain breaks. If you're purchasing your next home but your sale has fallen through and you don't want to lose your next property, a bridging loan can be used to finance the purchase of the property before yours sells and save the property chain from falling apart. Auction purchases. It's also well suited to auction purchases due to the fast drawdown of funds that helps the winning bidder complete their purchase within the 28-day time limit. Bridge to let. Purchasing an investment opportunity, refurbishing that property and refinancing on a buy-to-let mortgage. Buying land. Using a bridge to purchase a time-critical opportunity such as residential, commercial or agricultural land. Non-property purposes include raising cash flow for business or commercial uses, such as purchasing equipment or stock, investing in infrastructure, funding a management buyout, paying VAT bills or settling corporation tax. Or you could be looking to raise cash for personal use, such as having to pay unexpected bills, self-assessment tax or capital gains tax, paying inheritance tax or arranging a divorce settlement. There are so many uses. What are the interest options with a bridging loan? There are 3 interest options: serviced, retained and rolled up. Typically, in all instances, the capital sum is only repaid at the end of the term. The reason for this is that the purpose of the loan often means a borrower doesn't have the cash to service the debt each month, but instead relies on the sale or refinance of an asset in order to pay off the loan. This event of repaying the debt at the term end is known in the industry as the exit strategy. And a viable exit strategy is a requirement of the loan before taking out the finance. Okay, so let's look at the interest options. Firstly, we have serviced interest. This is possibly the easiest to understand, as the interest is paid monthly in a similar method to many traditional high street mortgages. Secondly, we have retained interest. With this, the borrower isn't required to make any monthly interest payments. Instead, from the outset, the lender adds all the interest to the balance of the loan and effectively pays the interest itself when it falls due at the end of each month. So the borrower is borrowing both the capital sum and the interest. As such, interest is applied to both. Lastly, we have rolled up interest. Similar to retained interest, the lender rolls up the interest and adds that interest to the balance of the loan at the outset, so again there are no monthly interest payments. The difference between rolled up interest versus retained interest is that the lender doesn't charge interest on the interest already added to the loan. What's the difference between an unregulated and a regulated bridging loan? Put simply, a regulated loan is regulated by the Financial Conduct Authority, also commonly known as the FCA, whereas an unregulated loan is not. Unregulated bridging loans. If the security you intend to use is an investment property, such as a tenanted residential property or a commercial property, then an unregulated bridging loan is suitable. Regulated bridging loans. On the other hand, if the property being used as security for the loan is your main residence, or close family members reside in it, then the loan must be regulated. Regulated bridging loans typically take longer to arrange simply because of the additional affordability checks that must be carried out for the applicants. What's the difference between an open or closed bridging loan? Closed bridging loans have a set date upon which the loan will be repaid, which is typically not more than 12 months, but can be up to 24 months. Most bridging loans are closed bridging loans. Open bridging loans simply don't have a set repayment period. This means you can decide how much to pay off and when. You'll still need an exit strategy, but just not a fixed date for it. Do I need proof of income to get a bridging loan? Proof of income isn't usually a requirement for obtaining a bridging loan, although there are some exceptions. The few instances where you will need proof of income when it comes to obtaining a bridging loan are if your exit strategy is linked to your income, when you choose a serviced interest option, or the loan is a regulated product. In most other cases, the application won't rely on your income because your bridging loan will more likely be repaid through the sale of a property or refinancing it. What's the best property asset to borrow against? Typically, the types of property that attract the lower interest rates for bridging loans are, in this order, residential property, mixed-use or semi-commercial property, commercial property, land that has planning, and lastly, land without planning. As a ballpark, lenders will typically offer a maximum loan-to-value of 80% on one property. If you want to achieve a higher loan amount, you can put more collateral into the deal, which would usually be in the form of another property. With additional properties in the background, it's possible to achieve 100% of your funding requirements. Let's look at the different property types and the different LTVs they offer. Residential property. In the UK, residential property is considered the safest property asset. Over the long term, a residential property appreciates in value and is considered a safe investment. There are many people who are in the market to purchase or rent dwellings. As such, this is also why lenders will often be willing to lend with higher LTV ratios on residential property, typically up to 80%. Not all residences are created equal though. A property in a prime location will always attract better rates than one that is next to a major trunk road or motorway. Mixed-use property. For the same reasons as residential properties being attractive security for a loan, mixed-use property, also known as semi-commercial, has an element of a residential dwelling incorporated into the building. The actual LTV will vary from lender to lender, but as a guide, it's similar to commercial property at 65% LTV. Commercial property. Commercial property varies greatly as to whether a lender deems it desirable security, hence why only up to 65% LTVs are typically offered. Even then, the type of use class it has, whether it's a restaurant, hotel, cafe, forecourt, golf club, you get the idea, all impacts its value to the lender. Of course, the location and demand for that property type will always play a significant role in its resaleability. Land with planning. Land with planning is typically sought after with developers eager to snap up the opportunity. Developers tend to look for undeveloped land for speculation. There are many companies in the UK that specifically seek out these land banking opportunities, and for this reason, they're usually appealing to lenders. However, it's unrealised potential, and lenders aren't developers, so will price their interest rates accordingly, and only typically go to a maximum of 70% LTV. But that will depend on whether the planning is for residential or commercial use. Land without planning. Land without planning may not appear at first glance as attractive as land with planning. However, that largely depends on what kind of opportunity the land presents. Half an acre of agricultural land is not going to be as desirable as half an acre of land for potential development. However, each will hold a value, and finding the right specialist lender will make all the difference to the loan amount you can achieve. There are lots of opportunities with land, be it potential garden plots for development, parcels of land adjacent to farms for developing additional revenue streams, such as equestrian centres or farm shops, or even strategic purchasing of brownfield plots. We say brownfield because since the Environment Act 2021, the UK has seen a gold rush for brownfield sites too, due to developers now being required to offset the green spaces they build upon, reducing the environmental impact of their builds. Land without planning tends to attract a maximum of 50% LTV. What's the difference between a first and second charge bridging loan? A charge on a property simply contains the details of any burdens affecting that property. This could be restrictive covenants, such as restrictions on the use of the property, positive covenants, such as obligations to maintain a fence or driveway, or debt obligations such as loans and mortgages. The term mortgage comes from Latin to literally mean death pledge, so the pledge to repay the debt until the debt's death. Mortgages are legal agreements by which a lender lends money at interest in exchange for taking the title of the debtor's property, with the condition that the conveyance of title becomes void upon payment of debt. When it comes to bridging, the charge will be a type of mortgage, and whether the mortgage is a first, second or third charge simply infers which lender gets repaid first, should the borrower default. Technically, there's no limit to the number of charges you could have on a property, but it's typically not more than 3. A first charge bridge is the principal loan on the property, and it takes precedence over all other charges. A second charge loan, meanwhile, is secured against a property that already has a loan or mortgage outstanding. What are the possible exit strategies for a bridging loan? In order to take out a bridging loan in the first place, you'll need a viable, robust exit strategy. This is typically either the sale of the asset or the refinancing of the asset onto a longer-term finance such as a mortgage. If you have an alternative repayment proposal, we'll work hard to find a lender who'll accept it. Digging deeper into bridging loan uses. With so many possible uses, let's look a little closer at some of the more popular uses for bridging loans. Fixing a property chain break. For example, perhaps a buyer has pulled out of buying your home, but you're still required to purchase a new property. A bridge would enable you to do this. Buying a property to flip. The process of purchasing a property, completing renovation work, and then selling on for a profit, all possible via bridging because of the short-term nature of the funds. Buying a property to convert. Whether it's converting a residential property into apartments, or an HMO, or a commercial property into dwellings, bridging loans can be used to finance both the purchase and conversion of the property. Buying a property to rent out. The process of purchasing a property, possibly completing a refurb, and then refinancing onto a buy-to-let mortgage, a bridging loan can make this possible. Buying an unmortgageable property, a property that's not at the standard that a traditional mortgage would require, yet it's totally possible with a bridging loan. Once a refurbishment or renovation is completed, then the property can be refinanced using a traditional mortgage. Buying a property at auction. Typically with an auction purchase, you're required to purchase a property within 28 days. You simply wouldn't be able to do this with a traditional mortgage, however, you would with a bridging loan. Buying a property with a short lease. Mortgage lenders will typically decline to offer a mortgage on a property where the lease remaining is less than 80 years. As such, sellers of properties with short leases often fail to realise the true market value of the property because they are only able to attract cash buyers. Buying a property with a short lease can offer both first-time buyers and property investors a good opportunity of buying below market value and then, relatively quickly, increasing the value of the property. Bridging loans can be used to both purchase property with short leases remaining as well as funding the lease extension itself. Buying land. Land with or without planning can be purchased with bridging loans, including development parcels, commercial, brownfield and agricultural land. Downsizing your property. A bridging loan can facilitate the purchase of a smaller property in value prior to the sale of your current property. Paying care fees. Clients are often required to pay quite substantial care fees whilst their property is being sold. Bridging loans can be used to raise cash quickly until the property is sold. These examples aren't exhaustive, but give you some idea to bridging loans' versatility. How can you speed up the bridging loan process? We have a combination of tools, options, knowledge, and expertise that help speed up the process of you obtaining a bridging loan, including whole-of-market access from family offices, private investors, and exclusive products to the biggest specialist lenders, meaning we can go straight to the lenders who are most likely to want your case. Automated valuations instead of in person to speed up valuations. Joint legal representation, where you use the same legal team as the lender. Expert support, so you know exactly what's required and when. Close contact with all parties and effective case management helps ensure your bridging loan application stays on track. What are the fees for bridging loans? Aside from the interest of a bridging loan, in the UK these loans typically come with a range of additional fees and charges. These can include arrangement fees, broker fees, valuation fees, legal fees, early repayment charges, and exit fees. Let's look at each of these fees in more detail. Arrangement fees. Also known as facility fees, these are charged by lenders at the start of a loan agreement to cover the work involved in setting up the loan. These fees are typically 1 to 2% of the loan amount. Broker fees. Broker fees are charged by bridging loan brokers at the start of a loan agreement to cover the work involved in preparing the borrower's application and sourcing the most competitive options. The broker will present the borrower's case in the best possible light to create interest and, where possible, will seek to generate a competitive marketplace for the deal between multiple lenders, which offers the borrower the most beneficial outcome. It's important to acknowledge that with bridging loans, the most beneficial outcome may not necessarily be the cheapest, as it may come down to the maximum loan available or the specific terms of the finance. Valuation fees. Valuation fees cover the cost of assessing a property's value and condition, which is done to determine how much they are willing to lend against it. Fees vary depending on the size and complexity of the property, but can range from £200 to £1,000 or more. Whilst every in-person valuation will be completed by a RICS-assessed surveyor, some lenders will require the valuation to be completed by a company from their own valuation panel. For this reason, before getting a valuation on a property, it's worthwhile to know which valuer your lender will want to use. Asking whether you can have a copy of the valuation report could also be of benefit to you. Should that lender not approve your finance, then you could potentially negate further valuation fees, as some lenders are willing to use valuations providing them within a certain time frame, i.e. less than 3 months old. This, however, is typically only applicable to residential bridging loans. Legal fees. Legal fees cover the cost of legal advice and customary paperwork associated with a loan. These fees can range from several hundred to several £1,000s, depending on the complexity of the situation. Early repayment charges. Early repayment charges, also referred to in the industry as ERC, are imposed by some lenders if you pay off your loan before its due date. These can range from 1 to 5% depending on how early the loan is repaid. Exit fees. Finally, exit fees are charged by some lenders when you pay off your loan. These are typically 1% of the amount outstanding at the time of repayment. It's also worth noting that not all lenders charge all fees, and some lenders have different ways of charging the fees outlined here. What's the process of applying for a bridging loan? The process of applying for bridging loans can be broken down into the following 5 steps. Step 1. Initial consultation call. This is where we understand what it is you're trying to do and your circumstances. During this call, you'll receive an indicative proposal with terms of what this finance might look like in terms of cost, timeline and fees. Step 2. Application. We'll liaise with you to collate all the documentation the lender will require from you. We'll package up your case in the best possible light, ensuring that lenders we approach see the value in your loan. We'll only approach the lenders we know who will be interested in your loan. We aim to find multiple lenders to provide offers to you and create a competitive market for your deal. Step 3. Decision in principle. Our lenders confirm that they're happy with the terms we provided to you, subject to valuation and legal work. Step 4. Valuation and legal work. We'll confirm whether an automated valuation or a physical valuation will be required for your property being used as security, and then instruct valuers. Next, the lender will complete their legal due diligence, including any searches on the property. Step 5. Payout. Once all the legal work has been completed, your solicitor will request the funds on the date of the completion and they'll be paid out. Here's a little more information about us. Our mission is to structure the right deal for you, always. A bridging loan should either help you save money or make money. We pride ourselves on truly understanding your requirements and unique situation. We're flexible in our thinking and will structure deals that get you where you need to be. We offer experience-based impartial information and will find the most competitive quotes for your financing from the whole of the market. We present your application to our lenders in a way that highlights its strengths, providing you with the best possible opportunity of acquiring the funding you require. And when we say the whole of the market, we mean it. We don't just deal with the big lenders, we've many specialist lenders, including private investors and family offices. We also have exclusive products with lenders enabling us to raise finance within 72 hours. So where your timeline is critical and short, we're confident we can get your funding in place. If you're considering bridging finance or you have any further questions, you can contact us for a free, no obligation consultation with one of our expert bridging advisors.